are officially live on YouTube for the Not Your Average Investor Show Tuesday edition. Today we're doing Not Your Average Insights with me, your host, Pablo Gonzalez, and the guy that I affectionately like to call GC because of his genius concepts, because he knows how to generate cash flows, because he's a great co-host, because his name is Gregg Cohen. Say hello, Greg.
Hello, everybody. Great to be with you. Great to be with you, brother, in the studio. We're back in the game.
Oh, that's right. I wasn't here last week. I was sick, and I wasn't here with our great community manager, MTM, because of the moments that matter, because her name is Madison the Magnificent. Say hello, Madison.
Hello, everybody.
Good to be back in the house, in the studio. Good to be here with the Not Your Average Investor faithful. And if you're listening to us on the podcast, you're watching us live on YouTube right now or later down the line on YouTube at some point in the future here. We love having you, but the best way to experience this thing is to show up live. Go to nyais.com, register for a show, and just pop it on your calendar. And, you know,
Just a quick pop.
Just a quick pop, but it pop. Just a pop.
Pop it lock.
You like it when it goes pop, pop, pop. All right, speaking of popping, the chat's popping. You know what they're ready for?
The roll call, baby.
They're ready for the roll call. Here we go. We got Madison welcoming everybody. We got our leadoff hitter where he belongs, John Henning, saying good afternoon. We got the fairy godmother of the Not Your Average Investor Show community. She's the first one that confirmed that we're not complete idiots with this, me, that I'm not a complete idiot. Jen fills in. Welcome to the show.
You called me that many times.
We got, not to your face. We got Raj Bantu in the house. He's saying hello all. We got the MVP of the Not Your Average Investor Show community, Lee Bishop, ladies and gentlemen. We got Nadeem Shah from the West Coast with his trademark good morning, good afternoon, JWB family. We got the ringmaster of the Not Your Average Investor Show community, Drew Barnhill in the house. We got the man that everybody knows as hailing from California, Noah Randari in the house. We got Chris Gonzaga from the illustrious Hudson Valley of New York saying great day, everyone. Who else? We got the patriarch and the matriarch of the first family of the Not Your Average Investor Show community. We salute you, Ken and Carolyn Meline. We got Aaron O'Neill stepping into the lights. Into the lights. Aaron O'Neill. We got our regular Rosalind Riley. Good morning, everybody from Murrieta, California. We got the mother of the godmother of the fairy godmother of the Not Your Average Investor Show community.
Carry the Niner.
World famous best-selling author Lydia fills in the house. Who else we got in here? Scrolling through. We got Eddie Harris from Hotlanta checking in. Good to have you back, Eddie. We got Gary Riley checking in. Good morning, everybody, says Gary. Gary, good to have you back as well. We got Peter James wishing you a top of the afternoon from the great Commonwealth of Virginia. Great to have the prodigious Pablo back. This is T. Peter James. Tip of the cap to you, sir. We got somebody hollering at us over here. We got Hervé Francois from Jersey wishing everybody a happy Tuesday. Hervé, welcome back to the show, man. Haven't seen your name in a minute. We got David Bladner. He's back. Hi, everyone. This show should be real interesting. You said it, David Bladner. We got Bill Shields with his trademark. Buenas tardes, amigos. Buenas tardes, Bill Shields. Good to have you in the house. We got Joshua Wedding. He's back as well. Joshua, you're becoming quite the regular on the show, buddy.
I love that.
Yeah, I'm married to the idea of you being here. Joshua Wedding never gets old. Happy to be here with you all. My JWB properties are the best part of my diversified portfolio. Thank you, Joshua. That's awesome, man. We got Sean Fletcher checking in saying, I know it's off topic for today, but can you guys give a short mention of Jacksonville post Hurricane Ian? Yes, we can, Sean Fletcher. Absolutely. That's what happens when you show up.
Yes,
we got Marie Rockoff. Good morning from Arizona. Marie, good to have you back as well. And cool. Joshua said classic when I to my stupid dad joke. So I appreciate you, Joshua. thanks for having a sense of humor. This is, as we like to say, our favorite content format, our Not Your Average Insights, where we scour the digital world and the analog world for topics that matter. Today, we're talking about three things, plus giving who was the request today? Giving Sean a little hurricane update for you, Sean. But we're going to talk about Mr. Jamie Dimon, the CEO of JPMorgan Chase. He has been in the news lately, rattling up some cages about the looming conditions of the markets. We're going to be talking about the consumer pricing index, which is also referred to the CPI in some circles. In other circles, it's referred to the CPI based on what's happening over there. And we're also going to talk about these headlines that are coming out about housing pricing dropping, I think is going to be real interesting. I think,
yeah.
why don't we do the quick give the people what they want. Sean wanted a post-hurricane update in Jacksonville. Why don't we hit that real quick, GC? What do you see as the post-hurricane
Yeah,
update?
you know, and it's interesting that you ask, because I know this is still on the minds for a lot of investors. It's, you know, those who live in Jacksonville, we have moved on, right?
I forgot it happened.
Yeah, this is not a thing here in Jacksonville anymore. But just the other day, you know, 2 or 3 folks, I know we heard it on our sales calls and whatnot. People were saying, well, does the hurricane coming through, Hurricane Ian, affect pricing? And what have you done to change the whatever due to Hurricane Ian? And so it's good that we talk about this. Just so everybody knows, Hurricane Ian didn't actually hit Jacksonville. It was Tropical Storm Ian is what hit Jacksonville. And we were all very, very thankful and blessed that the storm did not hit us, did not have a direct hit. We actually have not had a direct hit from a major hurricane ever, as long as they've been tracking it, which is really great. And I'm certainly going to knock on wood there. But this was no exception, meaning that the brunt of the storm missed us, and we're very thankful there. Super, super proud of my team's response. We talked about how this would be a moment where a vertically integrated company can shine. When we have clients, over 1,300 clients, the vast majority of you live outside of the state of Florida. You probably never experienced a hurricane before, and you have hundreds of thousands of dollars under our management. And this was a moment for us to shine. And so our entire team rallied. The great news is that we prepared for the worst, we hoped for the best, and we had just about the best outcome. Yep. Just to give some stats on it, we checked the week after the hurricane, and we had less than 1% of our properties had any form of maintenance going on at that point in time.
Wow.
And that's pretty normal for us, right? So less than 1% of properties had maintenance going on at that time. That's storm maintenance, that's just regular maintenance, all of those things. So the call volume, the damage that would come from the storm, I mean, this was like a normal week in JWB land, and we're very, very thankful. We were prepared for it. It missed us. You know, those clients who were affected have been reached out to, those residents have been taken care of, and it is all systems go, full steam ahead for, you know, a couple of weeks now.
So just to be clear, a week later, everything was back to complete normality, right? Like no statistical, nothing different, right? Like as far as operations go for JWB and maintenance?
No, it didn't even take a week to get back.
Okay.
It was like the day we got back, we were tracking the percentage of calls, percentage of work orders. Like I'm saying, it was consistent for that entire week.
Cool.
We had less than 1% because we didn't know if they were going to come in 2 days later, 3 days later, things like that.
Got it.
So it was like back to normal, let's say within a day or two. Yeah. And now there was a lot of additional prep and communication that we continued to do. But as far as damage from the storm, guys, it was a non-issue, and we're very thankful for that.
Good stuff. David Blanner's asking if he hasn't gotten a call, it means nothing happened, right?
Exactly.
No news is good news.
No news is good news.
I can tell you just from a quality of life standpoint, living through it, I left midway through when they said that the hurricane was here and like drove to Alabama, and the roads weren't bad. It was actually great. There was no traffic whatsoever. Right. And my windshield wipers were at like intermittent most of the time. And what I can tell you is I think the beaches took the actual beach itself took a beating, right? Like the dunes, you can tell there was like a decent amount of erosion from. Yeah. Nothing anywhere close to any properties that we own. My favorite surf break, like the beach exits all took a beating. They were all built within, like by the following weekend, they were all rebuilt. The place that I go is like a semi-private park. They're still working on it. So, but that's about it. Like really the only remnants that you can see of the hurricane is if you walk off the beach and you see the dunes, you can tell that they've eroded a little bit, but it kind of gives it like an epic kind of California quality on it.
Yeah. Agreed. It's just there.
Not good for, but yeah. All right, cool. So that's the hurricane update. Thanks for asking, Sean, and we're happy to oblige. Now let's talk about our topic du jour. That's the topic of the day.
Stole it from me.
That sounds good. I'll have one of those. So Jamie Dimon, CEO of JPMorgan Chase. I feel like I've heard this headline before, right? Like I feel like when we were first starting the Not Your Average Market Insights, one of the first things we're going to roll with was Jamie Dimon just got like big quotes, but this was like 6 months ago. But once again, made a whole bunch of waves at this like conference, like an investor conference, something or another, talking about really, really tough times being ahead and, preparing for this like economic storm that's happening. Why is it even news right now? Didn't he already say this, GC?
Well, he has been saying this for a long time. First of all, whenever Jamie Dimon speaks, markets listen. He's the CEO of JPMorgan, right? One of the largest investment banks in the world. And the reason why it's making more news now is because this is when earnings come out for companies. And so people always pay attention to earnings because it largely affects stock prices, whether people hit expectations, didn't hit expectations. Remember, it's not about making money or not making money. It's did you do what you say you were going to do? And that's really, what affects, stock prices in the short run there. So people are really looking at earnings to see how did these publicly traded companies perform. And it's an opportunity for the heads of these companies to be held accountable and also to give their thoughts on the market. And he is probably the most visible. And, but this is not something new. He has been talking about how the stock market and the economy are in for a rough ride. There's a couple of noteworthy things here because I went and I did a little bit more digging in here. He specifically said, listen, I know that the markets have dropped over 20% now. I think the markets could drop another 30% on top of this.
Okay.
He also got specific on the timing of this. So he came out and said, listen, in his mind, he's thinking that by midsummer of next year, by mid-year and summertime next year, he's looking at the amount of savings that people have been able to keep through the pandemic. And he's looking at that being largely tapped out based on spending levels right now. And so he expects consumer spending to dry up significantly in summer of next year. And he says that he thinks people are going to be unprepared for this. And so he is expecting a tremendous amount. Well, he's expecting a recession. Depending on whatever your definition of a recession is, tough times economically are coming in his mind. And he has been very specific about these warnings. And also the reason behind it, I think, is cool to just conceptualize, right? Doesn't it make sense that like right now, even though spending, even though it costs more for us to live because of inflation, and it costs more for us to borrow as a business or as an individual, all of these costs are rising. But we really haven't felt the economic pain of that yet. As an economy, we had more money in our savings accounts over the last 2 years than, in recent history. And if you think about the effect of inflation over time, it erodes your capital. And so he's kind of put some thoughts to it and says that by mid next year, that's when the pain should really start to hit. And it's going to be severe in his mind.
Yeah, what I read into it was, well, first of all, Chris Gonzaga saying nearly 50 trillion has already been wiped out of investors' portfolio this year, which is not in the stock market, right?
But think about that, because that's an incredible number, right? But does that affect your day-to-day for most people?
No, I guess not. I guess unless you are retired and living off of a stock portfolio that is supporting your lifestyle.
True. It's not good, and it does affect those. And I don't want to marginalize that because that's a real challenge, right? We've talked a lot about that on the show.
Yeah.
But the next shoe to drop is when you just don't have the money in your savings.
Correct.
Right?
That doesn't affect my spending day to day. Doesn't affect whether or not I went out to dinner tonight.
And that's really what's going to hurt our economy, right? I think we're just going to see an avalanche of a recession and tough economic times. And we've been talking about this for a while. And it's because when those savings really dry up, consumer spending stops, that's when job losses happen. And that's when our economy really starts to hurt.
That's what I found interesting, is the idea that, for me, in my circles in like LinkedIn world, where I network with other marketing departments and marketing professionals, I have in the tech space, I know that tech companies have already done some layoffs, right? Like the venture capital backed company that's been like living off of an insane burn rate because money was free, they've tightened their belts, right? So to me, I get a little cognitive bias, but what he said is that unemployment hasn't even hit.
Exactly.
And we've already lost 20% in the stock market. So when unemployment hits, he's seeing another 30% going down, beyond the fact that, inflation's already raging and interest rates are going up and all this stuff.
Yeah.
Like what is there to take away from that, GC? Like what are people saying? What's the move?
Well, I think, I just don't think there's ever been a time that I can remember when the economic signals of paying for this economy are coming, right? Like, listen, we've had 2 consecutive quarters of negative GDP growth. And for most of us, that means recession, right? But we've never had 2 consecutive quarters of negative GDP growth with a raging job market like we've had, right?
Correct.
We're still adding hundreds of thousands of jobs.
Yeah.
So it's this weird thing that people are like, well, is this a recession? Is it not a recession, right? If you don't want to call it a recession, this is the greatest indicator that I've ever seen of a recession coming is 2 negative quarters of GDP growth.
Yeah.
Knowing that, interest rates are what they are, and knowing what the Fed is saying about how important it is to control and rein in inflation. And so the takeaway for all of us needs to be, how am I best set up in my asset classes, knowing that economic hard times are coming? How am I best set up to survive and thrive? And you have choices. You don't have to be like everybody else who just has their money in the stock market, right? The normal approach for people, if they don't think that things are going to go so well in the stock market, is they put their money to bonds because that's more conservative. But that doesn't work right now. We don't have a Mark McGuire bonds market right now. We have a
bear market.
A Barry bonds market.
A Barry bonds market. Oh, man.
Barry bonds market.
I was like, a Sammy Sosa market? I don't know.
A bear market in bonds right now. And that's just because normally in a recession, the Fed actually lowers interest rates to encourage spending. This is weird, right? There's no place to hide right now if you're going in the stock market and in bonds. So if there was ever a time for you to look for another asset class that has risk mitigation built in, that has 5 profit centers named rental property investing, right? This is an opportunity for you. And, I think this is a time to be defensive with your money.
Yep.
And, listen, the reason that I quit my corporate job, a conservative guy like me, was not because rental properties was this huge opportunity as I was going to, make $1 million tomorrow. I loved it because of the risk mitigation aspect of it. And I felt like I could build a portfolio over years and over 10 years and over 15 years. Then I could call my own shots with my own time. Right. So I think all of this is really related. And I think these are strong economic indicators that this pain is coming. And go and check how the stock market works during tough economic times. And then go and see how rental properties perform. Yeah. And you'll see why I think we're set up in the short run and the long run to perform well on the property side.
When we have this conversation, GC, I feel more and more grateful every day that I have this like cognitive bias of this show, of this community, that I have you in my ear, in that I knew that, right? Like that I listened to Richie talking about the deal being in the debt a year and a half ago, right? Like this idea that I think it was like February this year, I cashed out my 401, an old IRA, and my stock, my investment advisor was like, what are you doing, man? This is not the right move. You're going to take this haircut. Like it's all about time and market. And I'm like, dude, I think we're about to drop. So like that was before that 20% drop.
Right.
The idea that 30% is about to happen some more. And I was able to lock that all in. At that time, the equation was, I know interest rates are going to go up also, and the stock market is going to go down. Mm-hmm. Nowadays, interest rates have gone up, but the stock market is still going to go down. Is the equation still similar? Like,
here's how I would think about it. Let's say that Jamie Dimon's wrong. Let's say that the stocks perform like they normally should. Over the next 10 years, your stock portfolio is going to make, 10% per year-ish. Mm-hmm. Let's just say that. In that scenario, rental properties perform at an upside of 20 to 30% on a return on investment, right? Listen, if the stock market is making 10% a year, when we do our property of the week on Thursdays, we routinely show properties that are, 12% returns,
12 plus, yeah,
right? Even 13% returns sometimes, right? So even if the stock market continues to perform like it historically does, and you're in for the long haul from this point, and you're making 10% on it, real estate still has 20 to 30% more upside. But that's not really why you should be taking a look at it, in my opinion. That's just real. You should be taking a look at it for risk mitigation. Like right now, real estate, right, is set to perform so much better than the stock market is. And so, So I just don't even think you have to go to the depths of saying, wow, there needs to be another 10% drop or 20%, 30% drop. That very well may happen, according to Jamie Dimon. That may happen. That may happen, right? But that's not the reason to do this. That's like the reason for you to perk up and like start to investigate a different way of doing things, which would land you to an asset class that has more upside and more risk mitigation built in.
Makes sense. Donna Chica is telling us right now that she rolled her 401k out of the stock market and into a self-directed IRA, and then bought 2 houses from JWB. So she's grateful.
All right, Donna, congratulations.
I know Jen Filzen just recently completed.
That's awesome, Jen. High five for you.
Jen, we were high-fiving this morning on the run when we find out. I was like, hey man, I heard, like we're like tracking properties that have been sold based on like show attendees. I was like, I saw Jen Filzen's name come through. So hooray for Jen, who's been working on that one for a while. Well, is that what everybody's saying? Do you see like at this point, we keep on hitting this like not your average investor drum. There did feel like there was a time where the world blinked and all of a sudden everybody was like rental properties.
Yeah.
Are people going back to saying that again, or are you hearing different things out in the ecosystem? No. Like, is Jamie Dimon like, hey guys, run for the hills of Jacksonville? Like, what are people recommending?
No. It was a nice moment where I felt like we were just at like the intersection of like what everybody, like the media and everybody else was like, oh, go and invest in single family rental properties because interest rates were so low and blah, blah, blah. And prices were.
I felt like a real good marketer at that.
Yeah, you were the best. You were the best. Right?
Yeah.
It's not that way now. You gotta be a not your average investor. You gotta look beyond the noise, right? And I know one of our segments here, we'll talk a little bit about real data points, but if you're just thinking about this right now, there is so much noise out there telling you that real estate is set for a crash or real estate is not a good investment right now. And there's a number of things they talk about, how sales have fallen off a cliff, and we all know what it's felt like for 2008. So don't be caught holding the bag, just like, and so it's not easy to invest in rental properties right now. You really need to surround yourself with the right people. This community is one of those, assets for you. And you have to dig, you have to look at the data. And that's what I like to do here for the show, because the data tells a very different story. Right. I was looking up I looked up an article on the Motley Fool, which I don't know if you all follow the Motley Fool or how you feel about it. Right. I don't usually follow it, but it happened to be the first one that was responding to Jamie Dimon's words. And it was giving advice for what to do, knowing that tough economic times are coming. And I thought it was really interesting. I'm going to read some quotes here. And then if you just thought about it differently, like if you just didn't think that stock investing was the only thing for you, if you were open to rental property investing, see how this advice might work. Okay. So number 1, it's all about writing out the storm. This was their advice for the stock market and why you shouldn't be taking your money out. It's all about writing out the storm. Money in your brokerage account should be money you're not planning to touch for a good number of years. The market might come up after it plunges. Like for me, no matter where my money is, like I hate that advice. That's just like pack up and, tuck my tail between my legs and just take the beating that I'm about to get.
That was word for word what my financial advisor told me when I was cashing out that IRA.
Yeah.
He's like, I got a newsletter coming out. It's going to tell you that what you need to do is stay in the market. And I'm like, I got it, bro. I'm getting better advice.
Yeah, exactly. Right. So now if you have the lens of rental properties, right, you can look at short-term and long-term. You can look at all 5 profit centers, and it's a much different lens that you have to have. There's no storm that you have to ride out if you're buying and holding rental properties that pay you 5 ways and you're in for a full market cycle, right? The market might come up after it plunges, right? When you lose 20% or 30% or 50% or whatever it is, it takes you a long time to recover. And if you're only counting on 1 profit center to recover, like that's a long haul. So I read a little bit more, and according to the Motley Fool, if you do plan to take out your investments, this is more concerning. You should look at other ways to get money in your hands as needed, such as a personal loan, but don't take it out of the market. Don't take it out of the market. Keep it in the market at all costs.
Yeah.
Right.
Yeah.
And then the last one, if you are in or near retirement, a 30% dip could be catastrophic, which is really interesting. They say, you really should look at having some of your assets outside of stocks, such as cash.
Yeah.
such as cash.
Such as cash.
So they're so close. And that last statement to like thinking about a well-balanced portfolio that's not so, overrun with stocks and bonds.
Yeah.
But maybe they just don't know that you can invest with a vertically integrated company and buy rental properties, because putting money in cash right now with a CPI of 8.2%, which we're going to get to in a second, that's like you losing 8.2% on your investment just again. So I don't like these investment ideas or options where I just have to take a beating.
Yeah. Yeah.
And so I think we all have the opportunity to not take a beating, and that's why we're here.
Yeah, that makes sense, man. I mean, I think about when, and that one, I think about Ken Moline, right? Like I think about how Ken had a certain amount of money in the market when it was doing well.
Mm-hmm.
And that only gave him, it was like under $3,000 a month to live. And then he figured out how to take that money, buy like 3 properties cash and finance a couple of others,
Mm-hmm.
and immediately increased his like take home pay to $5,000 plus a month. And this was somebody doing it in their 70s, like the idea that if you are in this spot in your retirement and all they're telling you is just like, hey man, the best thing that you can do is just like hide it under your mattress and take it out little by little. Just doesn't seem like something that would create any level of quality of life. It doesn't seem like it seems like you are, okay, it's not in a market where it's going for a roller coaster ride, but it doesn't free me from the anxiety of what am I going to do? Am I like, how long am I going to be in this cycle? Right. Like you're still in an emotional roller coaster of, I'm not really doing anything. I'm burying my head under the, like burying my head in the sand.
Right. I think of it in two, like some of us react differently when we lose 20% or 30% in the stock market. And it's very much associated with your quality of life. Right. And if you're a younger person and you have time for it to recover, you're not happy right now, but it's not really affecting your day to day. But if you are an older person and you're nearing retirement or in retirement, like this is catastrophic.
Yeah.
Right. This is life changing. This is not good. And, if the best advice out there is just to, ride it out, like it's a tough time. People need to expand their horizons and get better advice.
Yeah. Ken's putting me worry. Thanks, Pablo. Ken, I've learned so much from you, man. I talk about you all the time, and that story is just incredible because I think it's one of those things where people think that this asset class, it's like, yeah, cool, it makes sense. If I am less than 42 years old, I will consider this. But but that Ken's story has really transcended that for me in a way that I feel very comfortable talking to just about anybody about this because there's a way, right? There's a way to do it.
Absolutely.
Cool. All right. So we're going to move on to the next one. For podcast sakes, we're going to publish this by itself because I think it's its own speaking thing. Let's hit the last 2 points here. Sweet. And wrap some more. The CPI. The CPI, Dios mío, where I come from. GC, you mentioned it on the Thursday call on the JWB Real Estate Capital of the Week.
Week.
And we touched on it a little bit, but I wanted to give you some space to elaborate some more. What is going? Talk to me like I am a fool. The consumer price index, I think we've mentioned it a couple of times. Can you give me like a real good definition of it and what it means to me as an investor first?
Yeah. So what the government does is takes a certain basket of goods and they check what the prices are on the basket of goods. And so that's food and energy and housing and a bunch of other stuff in that basket of goods. It's defined. And then what that allows us to do is to see how much have prices risen year over year. And what we all need to understand is that, right, we all don't like paying taxes, right? Nobody likes paying taxes. And when you hear the word taxes, we all are like shudder, right? I don't want to pay taxes. Well, inflation is just another form of taxation because it's not really about the money you make. It's about the buying power that you have, right? If I made a certain amount of money, but it costs 10 times more just for me to live, doesn't matter that I made more money this year than I did last year. I have less buying power. So like for all of us, right, we need to understand that inflation is just another form of a tax, right? And it's something that as an economy is not a good thing. As a country, it's not a good thing, because ultimately what inflation does is it hurts those who are lower on the economic scale, right? Those who maybe can't afford to, pay for the gas that week that might take them to a certain place. And what it also does is, especially when you have the ability to borrow money, especially if interest rates are still historically actually pretty normal. They were much lower before. When you have the access to borrow, and you can borrow for rates like we have here in the United States, which is way lower than other countries, it separates the haves and the have-nots. And so you don't want to have a society that has haves and have-nots. Income inequality is not good for our country. Inflation leads to income inequality. And so if you're thinking bigger picture, why this is a big deal and why the government's number one job right now and the Fed's number one mandate is to get inflation down, is because inflation is very hurtful to our overall country. It's not sustainable, and bad things will happen to it. And it also has the, when I say it's not sustainable, I mean, people will really be hurting a year from now if we don't get this under control, even more than they are now. But the potential here, and the reason why the Fed is raising up interest rates so much, and the Fed is saying, listen, I don't care about the pain that our economy has to feel, is because if they don't get this under wraps, inflation becomes a self-fulfilling prophecy, and businesses and people start to expect that this is what things should cost. And when that happens, it's very hard to go back. And so that's why the Fed is raising interest rates so much, is to avoid the self-fulfilling prophecy that can take a much longer and much more painful process to wind back. So how did I do there?
You did a real good job of making me really scared of inflation.
I think we should be scared of inflation.
Yeah. So, all right. So then the CPI is the measure of inflation, because it is the overall like pricing of goods, right? Like this idea that it's like the average of like what goods cost across a cross section. And on Thursday, you talked about the idea that it went up a tick. It's staying up. What's the motion there?
So actually, the consumer price index, the goal from the Fed is a 2% CPI.
Okay.
So 2% is the goal. We have been way above that for a long period of time. It was up to 9.1% at the high, and that was a few months ago. And we've all just been hoping that it was going to come down. The Fed has jacked up interest rates like we've been talking about, which should lower spending. But the big takeaway that we were talking about on Thursday is that inflation is stubbornly high, and everybody's hoping that it comes down, but it's just not coming down. It's at 8.2%. So yeah, it's come down a little bit, but over 8% is like 40-year highs for our country. Yeah. So the big thing is that if you go back a few months, we had kind of a bump in the stock market. It was a little rally, and there was this optimism that the Fed could create what's called a soft landing, where they wouldn't have to raise interest rates so much, and that spending would come down and inflation would just come down. And the air had just been taken out of that balloon and just pounded and stomped on. That balloon is in like a million pieces right now in the economy, because inflation is much more persistent and stubborn and much harder for us to tackle than the markets were hoping, and that most people thought, and that the Fed thought.
Have you heard anything around the idea? Like I feel like I just heard on T-Boy, right? Like they talked about something about the CPI of like, normally CPI gets like inflated by gas prices, by these like commodity prices that go up and down a lot. But then there's another kind of like sector of CPI that's more hard goods, that's less like volatile.
Right.
And it's that's actually up while gas prices have actually gone down a little bit.
Yeah.
Did you hear about that?
Yeah, definitely. So I think it's called core CPI.
Core CPI.
And so the Fed uses the overall CPI as a benchmark, but so food prices and energy prices are more volatile. And so they remove those because they want to see if the core products are going up and down, because those are much harder to change. And I think, and you guys can fact check me on it, if somebody wants to do a quick search, look up core CPI. I think it was over 6%. I think that's the highest that it's been.
Yeah.
And so that really has the Fed concerned. I mean, look at what the Fed's doing, right? How else can they bring inflation down other than raising the borrowing costs, raising interest rates like they have? Guys, they prior to a few, 3 months ago, 6 months ago, somewhere when they started raising rates, the Fed hadn't raised rates at a clip of 3/4 of a point in 28 years. They hadn't done a 3/4 point raise to interest rates one time in 28 years. And they did that. That was the first interest rate raise that they did. And since then, I think it's been 3 straight of 3/4 points.
Yeah, it's been insane.
So like they are throwing everything they can. They are literally signaling they do not care about sending our economy into a recession. So again, if you're an investor, ask yourself, how does the stock market perform in a recession?
Well,
it doesn't perform well.
Yeah.
It doesn't perform well. And when a bear market happens, the average loss in a bear market is 36%.
Yeah.
So when Jamie Dimon is saying that he expects there to be more pain, right? We haven't even gotten to an average bear market. And I hope people just see this in these incredibly poor economic indicators and these poor indicators for the stock market and also the bond market too, because the reason bond prices are falling is because the Fed is raising interest rates. They're inversely related. So if you think the Fed is still going to put pressure on interest rates rising, that means bond prices are going to go down. So this is the time to become a not your average investor, to think differently, to explore other asset classes. Tell your friends and your family to not just stay in the market blindly without thinking about it, right? This is the time. Invite them to this show, right? Invite them to learn from others who you think have valuable advice, because, this is going to be a time of a lot of economic pain, I think, for our country.
I read this book in like high school that's called like I think it's called Ishmael, actually, not Call Me Ishmael. That's the first line of Moby Dick, right? It's called Ishmael. It's like this parable of this like gorilla that can speak and tells the story of like nature and blah, blah, blah. And it made this like, within it had a parable of a guy that jumps off this like super high cliff and thinks he's flying. And as the ground is getting closer, he's like, no, but I'm flying. I'm good, right? Like I feel like I'm here. Everything's fine. Like I'm in the air. I must be flying. Ground's getting closer. He's like, well, ground's getting closer, but the data tells me that I'm flying, right? Like I'm in the air, and eventually hits the floor, right? Yeah. I feel like that parable is just like the average investor, right? The people that aren't looking for these other ways out, the people that are listening to this, just hold on, just grab onto this thing. And, there's nothing else, right? Like, what else are you going to do? Right? Like, put it in cash.
Right.
It feels strikingly similar. And as we're like telling this message of like, share the show with people and, educate others, I think it would help if you just kind of go back to what is the explanation piece, right? So inflation is eroding our wealth. The stock market is going down. Putting it into a rental property has an inflation hedging component. What is that component? What is the reason why this asset class particularly helps you deal with those two things?
Well, I think even in the best of times, the stock market does not have 5 profit centers. It doesn't have a cash flow component. It doesn't have a tax savings component. It doesn't have a principal pay down component. It doesn't have an inflation hedging component. And so I think even in the best of times, rental properties have some significant advantages. But now when you're looking at, like, listen, if stocks just drop 20% or 30% or 50%, like what else do you have to go for? Like, why else are you investing in stocks? Yeah. Like if you don't have that, it's going to take you so long to recover. And these economic indicators are so strong. So you say, like, what does that mean in rental property investing? In rental property investing, here's how we're set up to perform in the short run, right? You're able to buy an asset that pays you every single month. It's not going to change your life, right? It's not going to make you, allow you to quit your job, but it's going to pay you every single month, which is different. So a little bit of cash flow, that's a good thing, right? And then you think about how we're set up going forward, right? As homes have become less affordable, that creates more rental demand for us. So rents are expected to remain strong going forward, right? So this source of cash flow is better anytime because you have some in rental properties. It's set up to perform very well in the short run. And let's say that rents just stayed flat, which I don't expect them to do. Let's just say it stayed flat. Well, you have these other profit centers that definitely still happen. You have tax savings, you have principal pay down that happen. You can't stop those. I guess you could, but I don't know. Well, that would be a whole nother discussion, right? So you've got all of these things that are working for you. And I haven't even gotten to home pricing. Right? We'll talk about home pricing here, but all of these articles talking about how home prices are set to crash well, we'll just get into that. Well, that'll be a little teaser for this next section. So if you're just looking short run, right, because of those 4 profit centers like we were just talking about, you're set up for success, right? And then you're right, home prices and home rents they're a hedge against inflation, because as inflation tends to happen, the price of rents and the price of houses tends to go up at a similar rate over time. So you've got just this incredible opportunity to continue to earn a great return on investment and cash flow. And cash flow and money in your pocket is nice. It's not going to change your life. It's nice, but it's much better than the alternative of having only paper assets and only hoping those go up in value just to see them go down 20% or 30%. All right. So it's those other profit centers, and I haven't even gotten to home price appreciation yet.
Yeah. And to me, the stuff that's really starting to hit home, and again, it's been like 2 years of hearing inflation hedging, right? Until it finally starts to make sense because the inflation's on fire all around us. But it's kind of what Lee is saying. Rent keeps up with inflation, right? Like if we believe that upwards inflation means downward stock market, then you're like in a no-win situation. While if you are upwards inflation, upward rent, because inflation is pricing and pricing is what inflation is correlating to, at least it's hedging towards that. And then the other thing that you told me that is like, your home is priced at replacement cost value, right? So just like the price of, core inflation, right? The price of a window is going to be higher tomorrow than today, than to replace the home that you already have it locked in on. It's like that window that you have in your house is appreciating in value. The drywall you have in your house is appreciating in value, right? Like all that stuff is kind of just keeping up with that at the very least in a way that is even more efficient than like a 3% cost of living increase raise that you can really bank on, right? Like that part of it during this discussion in particular just really, really hits home for me, man.
No, you're right. And the key here is you just have to be in for a certain amount of time, right?
Yeah.
You just have to be in for a certain amount of time. And then some people will say, I don't want to invest in rental properties because I don't want to be stuck in rental properties. I don't want to be in for a long period of time. Yet they'll have their money in the market and they'll read articles like The Motley Fool, which tell you that you should just, money in your brokerage account should be money you're not planning on touching for a good number of years anyways. So it's like they let the stock market off the hook and they'll say, oh, listen, I'm just going to keep my money in the market because I know it's going to come back. But if they just had that same approach with rental properties, then they could buy into the things that you're talking about, which over time, rents and home prices do go up with inflation.
Murph Hayes brings up a really good point. Murph, I'm glad you brought this up because this is something that GC and I was literally asking him about this weekend, right? Murph says, okay, if we enter a recession by midsummer and unemployment jumps, then rental property risk will rise due to upwards rise of tenant rent defaults, which is where the current IRR projections can fail the under promise, over deliver motto. What do you say about that, GC?
Murph, it is great to hear from you, my friend. It's been too long. So thank you for being here on the show. I really appreciate this question as well. If JWB just put our IRR projections based on what happened last year or last 2 years or last 5 years, we could run the risk of what you're talking about right here, right? We could run the risk of putting an IRR projection that was based off of rent appreciation over the last year, right? Rent appreciation over the last year was 10%, right? You go to a JWB evaluation, you don't see 10% for rents. We use the 40-year historical average of 3.3% for rents going up, which is largely close to inflation, right? You look at the home price appreciation rate over the last few years. I knew the market was going up. We talked about it all the time on the show, but I never put appreciation of 5%, 10%, 15%, 20%. We kept it at that 40-year historical track record, which is 4.6% per year. So we do that because we're in for the long haul. We think long term, and things are going to change. And if you believe in buying and holding for a full market cycle, I don't have to change the numbers every past year. And I also don't have to change the numbers 6 months from now if there is a spike in unemployment. Because as you hold for a 10-year cycle to 20-year cycle, I'm really confident that we are going to hit our IRR projections. Part of the reason of that is because of our history. 100% of our clients are hitting their IRR projections. We've been doing this for 17 years. So I feel really confident. Now, to your point, though, if a recession happens in summer and unemployment jumps, will there be more of a risk of tenant rent defaults? Will there be more of a risk? Yeah. If you're just going based on that, right? In a recession, less people have jobs, right? That would certainly go up. But that doesn't mean that this asset class is set to fail in the short run, right? Unemployment right now is historically low, right? I think we should change our perspective. And right now, right, it is so good from an unemployment perspective that even if a recession happens, and when a recession happens, in my opinion, and you have more tenants that have a hard time with losing jobs and things like that, that's probably going to get us right back to normally the expectations and assumptions we have when we go into buying rental property, right? Like unemployment right now is like 3%, right? Like it is incredibly low. I've been buying rental properties when unemployment's been closer to 5% or 6%, and I didn't have a huge risk of tenant defaults. So I think number one, yes, absolutely, we are going to hit your IRR projections because we think long-term, and in the short run, this market from a job perspective our job, like unemployment is just so low. We have to flip it and just say, listen, our country can endure a little bit more of unemployment because honestly, that's what we need to get CPI down.
Yep.
And that doesn't mean that this is going to, make this a less valuable asset class, in my opinion.
Yeah, and I think about, one of the things that we talk about a lot is the resiliency of the Jacksonville market based on the economic pillars that drive it, right? Like, and within it is the port, the military, logistics, healthcare. And I think about the housing stock that the JWB housing stock houses, right? The people that go there are largely in these like jobs that are, blue collar jobs that are not the ones that get cut immediately, right? Like it's kind of like the infrastructure of America type of jobs. Is there something to that, or do you think that
it's part of the reason why we choose to invest where we do? It is out of all of the sectors of housing, right? If you're talking above middle income, below middle income, and low income. Yeah. Below middle income or workforce housing, that's where you mitigate the most risk. Yeah. And so we do that for a reason. And the type of jobs is one way to mitigate risk, right? So yeah, I think you're onto something there for sure. Yeah. Yeah. Like like the indirect juxtaposition to like my LinkedIn network, that's like venture-backed tech startup marketing person, right. Like that to me is the canary in the coal mine. Right. The teacher is not. I know exactly what you're talking about. Yeah. I just had a friend who, I had a call set up with him. We were going to be talking. Oh, that's right. And he let me know that he was let go, and it was a venture-backed tech startup. SDR, right? Yeah. And so I think we're all unfortunately seeing that in our personal networks. Before we get into this housing data, Raj has a quick question. Raj is asking, Raj is saying that he's on his third property manager in 2 years. How come property managers get rotated? Isn't it easier to work with the same property manager at one time? And he's saying that, like, I guess it's his service manager, like his like service team. Client portfolio manager is what he's talking about. So Raj is a client of JWB, and he's asking, why does he have a different portfolio manager here? And, over the last few years, we have gone away from the very specific, like this one person portfolio manager for you because of we don't want it to be a poor experience. We have a team-centric portfolio management experience. Now, you may talk to one manager more often than another, but we have done an intense amount of training and making sure that our systems and our technology can be there. So whenever you call in with a question on your portfolio, hopefully you get to talk to the same person that you spoke with before. But if not, anybody else is going to be able to jump in and be able to handle your portfolio. And that's really a change as we've evolved, because, we're not the same outfit where we had 10 clients and 30 clients and 50 clients, right? And so, we do hire a lot of staff and things of that nature. So this team-centric can be a win for our clients. And, a lot of other things that we do is even when we're doing monthly reporting and calls for our clients, we'll have multiple teammates that will be a part of that call, just to make sure that that it's not just one person. This isn't this relationship fails if that one person might not be on the team in the future or get promoted or something along those lines. It's really a team concept. So, Raj, hopefully that rings true with you, and maybe the fact that you had a few in the past, it's really been a transition for us over the last few years.
Do we want to squeeze in this housing data right now, GC? You think you can do it justice right now?
What are our other alternatives?
Let's go.
All right, let's do it.
All right, GC. Last and final point of Not Your Average Insights. The headlines are rolling through. Home prices are down. What say you, Mr. Home prices aren't going down guy?
Hot off the press, baby. Got hot off the press. Apparently, this press release did not make it to any of those news articles, though.
I guess not.
All right.
Too hot.
All right. I'm just going to give you guys the data, and I'm not even going to get too much just into the framing.
Be careful with your fingers. It's scalding hot.
Okay. So all these articles, you guys, I ain't going to frame it. All these articles you guys are reading out there is that home values are crashing and sales data is way down. And this is, you're seeing all these articles about how this is the next 2008. I'm just giving you real data. So what we talked about many, many months ago, as I prepared all of you, I said, listen, these headlines are going to be terrible for housing coming out. They're going to be talking about how home sales have gone down, which is true because home sales were so high for the last 2 years. It were setting records across the country. So you would expect home sales to go down. And then we were talking about how towards the end of the year, due to seasonality, home prices fall regardless. Like in every year, home prices fall. And so I said, well, geez, the national media is really going to look at month over month home prices falling. And they're going to say, look, this is a crash. And so I prepared all of you. Well, it's happening right now as far as those articles, but here's the real data. I went back from 2007 to 2021 in Jacksonville. I pulled the median sales price in July of that year, and I pulled the median sales price in September of that year. And I wanted to see what home prices did due to seasonality. Okay, from those 14 years, 2007 to 2021. Again, there was a great recession in there. And there was above average home price appreciation for like 10 years. And then, 2 years basically of huge home price gains there. So a very fair segment of time and real estate markets. Overall, from July to September, from 2007 to 2021, home values dropped 3.9%.
July to September 2007 to 2021, home prices dropped 3.9%.
If you just went for those months, just the seasonality
across the
years.
country.
No, this is Jacksonville.
In Jacksonville. Okay.
So in a normal year, this is over 14 years of data with the Great Recession, the great, whatever you want to call it, where home values just went up 2 years after the pandemic. Normal is that home values would drop roughly 4%.
Okay.
Just nobody talked about it. Right? Because then there weren't articles to write about it at that point in time.
Mm-hmm.
And then I just compared our home pricing here in July here in Jacksonville and our home pricing in September, which just ended, and we just have that data. Home values dropped 1.9%.
Okay. Okay.
So it's been less of a drop than even the average normal year from 2007 to 2021. Got some more data for you. I went back and I looked at the months of inventory in September for every year there, 2007 to 2021.
MOI, our favorite stat.
MOI, which would be a leading indicator of
the stat that Gregg put on the map.
The average MOI was 5.1. So 2007 to 2021, it was 5.1. Less than 6 would indicate higher than normal home price appreciation.
Mm-hmm.
So again, home prices fell more due to seasonality in those other years. MOI was 5.1. Now here in September right now, MOI 3.2.
Okay.
And then I took it one step farther. I looked at the next year home price appreciation.
There's more?
That's right, man. I can't hold back from this. Okay. The next year's home price appreciation from 2007 to 2021, after home prices fell, those 4% for those months. And after, as MOI was 5.1, home prices on average for those 14 years rose 4.5%.
Historical average.
Really close to the historical
really close
average.
to the historical average.
Right? So here's the takeaway. As we have talked about, the media is incentivized to get eyeballs and
to freak you out.
And this is low hanging fruit for the media right now to talk about how the market is set to crash. The market right now is actually performing better due to seasonality than it did for the last 14 years. Okay. We are seeing less of a drop. That's just the data. From an MOI perspective, we're still at historically low MOI. Now, here's the thing. There's a lot of variables out there. And this year is not, I'm going to be watching what's going on over the next coming months. I don't remember a time there was this much going on in the world with the Fed. Like this is important time to be paying attention. That's why I hope all of you continue to come back to the show.
Time out. MOI, months of inventory. Somebody just asked in the chat.
Thank you.
Yeah, months of inventory. How much available inventory there is that would be sold in, like how much it would take for no extra inventory to be sold out.
Yeah. How many months would it take to exhaust the current amount of inventory on the market?
Got it.
6 to 7 is normal. You would see normal home price appreciation, which is 4.6%. And less than 6 would be an indicator that you would see higher than normal home price appreciation.
Correct.
So my point overall is that home prices in Jacksonville are actually holding up really well. We actually saw an increase in pricing from August to September. Prices went up.
Year over year increase.
No, from August to September.
Yeah. Correct.
From 2 months ago to last month.
Yeah.
Home prices actually went up.
Yeah.
MOI is still where it is. So there's a lot that I'm going to be monitoring here, but all of this talk about how home prices are falling off a cliff and that's the reason to not invest and all of this stuff is literally not backed up by data. Right. So I'll keep bringing you the real data, but a very different story based on the numbers than what you're reading. Do yourself a favor. Surround yourself with the right community. With this community, it's one of the communities I'm sure that you get a lot of value out of. Don't just read the headlines. Don't just read the articles, especially when it comes to housing.
You know what I like about you, GC?
What's that?
You got credibility. GC, he's got credibility. As you were breaking this down, do you remember there was like a reporter called like Tom Haberstroh? He was big on for a while there.
Made that name up.
No, for real. Like I actually became friends with this dude in Miami when like LeBron and Wade and all of them were in Miami and all of ESPN lived in Miami. I got to befriend a couple of them.
Nice.
And he got known for just like finding this like one statistic to break a thing down on the Dan Le Batard show. And as you're like doing this, I felt like I was listening to one of these like radio programs where you're the guy that always comes in with a stat because you keep doing this, right? Yeah. Like
we're doing this for years.
Is it the data flywheel? Like, how do you know how to like research this stuff so well? Because spoiler alert, I come up with these topics for the show of the Not Your Average Insights, just like out of my hair brain. I'm just like, GC, let's talk about this next week. And I'm just like, I assume that you're just going to show up and you're smarter than me. But then you show up not just smarter than me, but you have these topics. Like, where does all this stuff come from, man?
Yeah, it's just a team effort. I mean, we have our entire team that prepares the data on these things. We are constantly looking at this. Like, I get my data, not just because I'm a data nerd and I dive in. It's because of our entire team. And, that's just what you get when you have a vertically integrated provider who's focused on one market. Like you have somebody, and then we also have our own money in this market. Like I'm about to go into business planning for the next year. I'm trying to decide how to manage this business. I need to know what's going on in the market beyond the headlines. And so, yeah, it's just a team effort.
I love it, dude. I love it. Another fabulous Not Your Average Insights, folks, here on Tuesday on the Not Your Average Investor Show. Thursday, we go to the JWB Rental Property of the week. Join us and we talk about the actual inventory that's out there and dive into the numbers with old got credibility data nerd over here, GC. And, just really, really appreciate the fact that we got about 50 people throughout this call. We still got 45 on us, over an hour into the middle of a Tuesday. Just never goes unnoticed that you're spending an hour of your day with us, and the immense value that it brings to the show to have this conversation happening, having people clarify stuff, letting us know if our audio is on, because I'm an idiot. So I just really, really appreciate the community here showing up every single time. And, if you're listening on the podcast, we hope that you like this shortened version that we're doing, right? We just released last week's show, a half an hour of it yesterday on Monday. Then we're going to release the property of the week from last week again on Wednesday on the podcast. And then Friday, we release the second half. So we're going to be doing that. Let us know if you like that format a little bit better. And the best way to let us know is show up to the show. Let us know. But if not, go to the Facebook group, shoot us a DM, whatever. GC, last words, buddy.
Just appreciate all of you. Thank you for giving us the platform to do what we love to do. I hope you guys can feel it, that Pablo, myself, Madison, this is our thing. We love to do it. And if we didn't have you to share it with, we wouldn't be able to do it. So thank you all. We appreciate you.
Yeah. Yeah. Thank you so much. And remember, if you want to listen, if you don't want to be the motley fool yourself, then you just can't be average.